Keith, let me start with you. A lot of clashing between the bulls who argue that seasonality trade this time of year is very tried and true, but the bears saying that the fundamentals, central banks, consumer downside risk means you should be cautious. Where are you?
Well, first, Carl, great to be with you on this Monday morning. We're still positive. We came into the last month saying that the market had a healthy reset. We told our clients to use that as an opportunity to position for year-end strength. Now, you are right as far as we are in a sweet spot seasonality. We look back historically. When you've seen 20-plus gains into October, the final 2 months of the year have been positive 8 for 8 times with an average gain of 6%. That's almost double the norm. Now, that's not a guarantee, but I think what will continue to support this market is we do think we're set up for positive economic surprises as we end this year. After the big run, maybe a little bit of digestion here, but we still think there's some upside before year end.
Interesting. Megan, earnings beats of in the 7 range is not, historically it's probably the weakest we've done since COVID began. But you seem to be impressed with the way companies are navigating some of these supply chain challenges.
Absolutely, Carl. This has been a quarter that we've been watching carefully because we see it as having had the highest risk of disappointment in quite a while. I wouldn't get deterred by lower surprise numbers, lower earnings numbers compared to where we've been since COVID began, because I think we have to get to a more normalized rate of growth. But we've been happy with how companies have delivered this quarter. Those supply chain challenges are very real. They seem to be hitting every industry, even those that seem to not have direct exposure. You think about some of the communication services companies that actually have indirect exposure through their ad revenue. So we are expecting this to persist for the near term. But we do think it sets up for a very nice backdrop beginning in the middle of next year. And I expect equities to start to sniff that out several months in advance. Namely, we're looking at a rebuilding of inventories at possibly historic levels, and that should be a support for growth.
So basically what I'm hearing from both of you, and Keith, I'm going to direct this next question to you, is that stocks are still relatively attractive investment alternative given the prospects of returns we could see potentially in other asset classes in a week where, and I feel like we have this debate every day, but in a week in particular where inflation commentary is in focus, given what we'll see from the Fed and the meeting and Chair Powell later this week. Keith, I mean, would a changing narrative about inflation actually change this perception in terms of risk assets?
Well, I think the inflation picture is a risk as we head into next year. But I think what we're learning in this earnings quarter is that companies are able to push those prices in many cases. And what's a really amazing stat this year that I think some people are unaware of is, yes, this market's up 22%, but forward earning estimates are up 30%. So last week we made a new high in the market and we made a new high in earnings. I do think as we move to next year, the overall market gains should moderate because valuations are still somewhat high and those earnings will come down. But on a relative basis, they're still attractive. And I also think you have to look more micro. Look at small caps. Small caps by themselves are now trading below their historical average and a 20-year low relative to large caps. Earnings are moving higher, and we think small caps are set up well into year end.